My name's Neil Peterson. I'm the founder and editor-in-chief of Real Estate Investor. We've got a digital magazine and online platform. We have weekly webinars. We do live events, and I'm the host and moderator, and I'm really delighted to be here. So thank you very much, to Daniel, to Carrot again. It's wonderful working here with the Wealth Assist team. And yes, our topic today is decoding the distressed property market. And I must say, I'm really impressed from every single time understanding that market quite well, being a property investor myself, and the dynamics of what's happened. I mean, everybody remembers 2009. We had in fact, global financial crisis, and we had a lot of houses being, taken away by the banks, and a lot of people were in distress. And I think we've learned a lot since those days. So, firstly, before we get on we've said our topic is decoding the distressed property market, and we also got our experts and with our homeowners, investors, and our specialists. We wanted to have the banks here today, and it wasn't possible. It's not because they didn't want to, and it wasn't going to be a bashing session. It was really to get perspectives from everybody so that there's a win-win for everybody. So we're really going to unpack this today. And it turns into great opportunity for you as an investor. So before I go ahead, I'd like to introduce you to obviously our esteemed panelists today. We've got Daniel Lombard. He's the founder, executive chairman of the Assist Group. He has an impressive 35 years in the industry, and I know in particularly in the distressed market, being at auctions, that kind of stuff, we've got an inherent understanding of what's going in there. And he launched this firm, which I think is really a fantastic concept, real estate advisory firm renowned for its expertise in direct and distressed residential real estate investment predominantly. But Daniel, welcome to you today. We want to say hello to everybody and all our guests out there in the virtual world.
Hi guys online. Thank you so much. Thank you, Neil. Neil always says he thanks me for always just promoting his magazine, but it's really not a thing about promotion. I think for me, the fact that I learned so much from the magazine, and I actually want to, just for fun, if you guys don't mind, raise your hands. Who of you are reading the current Real Estate Investor magazine as a real estate investor? Can you raise your hands? Okay, we've got one guy on the no and done. Okay, I think if you really want to stay informed about the property industry and various aspects of it, that's the actual thing that I like the most about it. It's the fact that there's so much variety. I think in our Johannesburg Money Summit coming up on the 14th of September, we are sharing the platform with a few other investors, other alternatives. And what I like about it is it actually really brings a broad perspective of all the different types of real estate investments, and I think that for any investor, and I actually don't mind the competition. I think there's enough money around, but I think it also helps people to get a better picture and quite an informed picture of what's happening in the industry. And if you want to invest in real estate, you either need to read a lot and pick the right team, which hopefully we are. And if you don't, then obviously you're going to have to do a lot of work and spend a lot of time yourself to actually make proper real estate investments, which I think I'm sure quite a lot of you do in any way. So thank you, Neil. Thank you. It's a privilege to be here, and it's a privilege to actually share time with you tonight, share some of our insights. I'm sure we can learn from you as well, but hopefully you can learn some things from us tonight. Thank you so much.
Learn from each other. So for those of you who don't read, which I know there's a lot since post-COVID, we have webinars, we have live events. We're even in the metaverse. So we're not a one-trick pony. Even though Daniel says we're a magazine, we're more than a magazine. We are a complete service company to the real estate in terms of property education. So that's really what we are fundamentally. Our second guest, of course, Gerard. And Gerard van der Westhuizen, a little bit about Gerard. He's the direct real estate officer at the CIS Group. He has an illustrious track record, 30 years in property investment, financial planning, and also in the property development sector. Welcome to you, Gerard. Do you want to say hello to everybody out there?
Thank you, Neil. Yes, thank you. It's wonderful being here again. I must say, I always say to my family who's online now tonight as well, come and listen. You'll learn something because there's really a lot of knowledge in this industry, and I think we'll add some value tonight again. So I'm very excited to welcome our guests and the people online. I'm sure that it will be of great benefit for you tonight. Thank you very much.
Absolutely, and learn you will, definitely, without a doubt. At the end of the day, there could be a sale that is made, but that happens in the process. It could be an opportunity, and there are massive opportunities out there. Right, we've got our third guest, and he's not here. He's not in the room. I don't know if he's hiding somewhere, but he's certainly online, and his name is James Ayres. So James is an independent consultant with Body Corporate Funding Solutions. He's a co-owner of Stratton Morgan since 2010. They are a company that specializes in boutique investment opportunities in the distressed sectional title and homeowners association industries. Before that, he was operations and franchise manager for Wizard Financial Services. Since 2002, in the beginning of 23, James was presented with an exciting opportunity by the CIS Group in this distressed space. So welcome to you, James. Do you want to give a welcome, a virtual welcome to everybody? We're going to pop him on the screen, or you're going to, certainly we know he is online on the platform.
Well, thank you very much for that. Apart from Cape Town, which normally lags behind Gauteng, where I'm from, we skipped spring. We just jumped straight into summer. We had a 30-degree day today. So yeah, besides that, thank you very much for the invite. And it really is an honor and a privilege to speak, sit on the panel with you guys tonight. Thank you very much.
Wonderful. Great having you on board, James. And I think to get another perspective, I think what we want to do is to try and bring in different perspectives. We try to get the banks in here. We still will get them in the future. And I think it's very important. How are we going to roll tonight? Okay, we've got 3 brief presentations, and then we'll end in a Q&A session. So we obviously welcome you to please ask questions, and if something doesn't make sense, you know, we've got that piece right at the end of the presentation. We've got the Q&As, and that's where we want to get through the presentation, put it on the table, get you thinking, get you talking, asking questions and engaging. And also for you online, there's a Q&A box, and just drop your question in over there, and we will deal with the questions at the latter part of the presentation. So let's get the show on the road. And I think, you know, if we look at where the South African economy is right now, it's not in a good place. And it's not only the South African economy, it's a global economy. And I mean, we've got our own set of problems. We've got load shedding. We're stage 6. We've got a fantastic currency to the dollar, 20 rand to the dollar. Remember many years back getting investors in South Africa in 2012 at 8 rand to the dollar. We're now 20. The municipalities are dysfunctional. We can carry on, we can moan, we can complain, we can say this is not good. And I think part of it that causes this distress, because the unemployment's low, all these different things, is it causes distress in the property market because people lose income. We've got inflation, massive inflation. And tonight, ladies and gentlemen, a little tip for you. If you haven't filled up your tank, do it tonight. You've got until 12 o'clock, okay? Your diesel is going up by 2.70 rand per litre, and petrol 171. So I've already saved you all money. So straight after this event, please go fill up your tanks. You've got until 12 o'clock to do that. But we're getting on to our first question with Daniel. Daniel, give us a rundown of the current status of the impaired and distressed property market, because I think it's important to set that scene, to explain to what is it all about and how does it look.
The first thing is, guys, how much time you're going to wait in those queues tonight. If you're actually going to do business in that hour, I can advise you to fill your tank tomorrow, because that number or rands, when you actually work it out in saving, even with the expensive petrol price. There's lots of better investments to do. But, and anyway, yeah, so let's quickly look at what's happening in the market at the moment. And I think this is really like just a summary, try to put it in one picture. If you look at what happened in the past, over the past few years, I think the first thing is looking at the arrears for 90 days or more. If you look at that stats from 2019, we were at 3.8%. Then during COVID, we obviously understand the hard lockdown, there would be far more arrears in that case because a lot of salaries were affected. And then it kind of smoothed out a bit lower. I think the reason for that was also because there was a lot of, the banks have actually made a decision to not immediately react. And for those who are in the industry and knows the distress market well, will know that there's always a lag time of another 6 months or so. Apart from the new, call it Rule 46 and various other things, which actually creates more time delays. Then we talk about the courts getting you to that sale and execution or whatever that term is, which is even longer. So, and I think all those things are obviously have an effect on the results at the end of the day. But if you look at the number of families in trouble, currently there's about 90 days or more. Arrear mortgages is about 56 billion rands worth of mortgages. So that gives you a very good idea. What is the large potential to solve problems? You know, I spoke to James earlier today, and he says, you know, big problems create big opportunities. But that's if we want to do good. And this is the idea of what we have here, is we're looking at that figure and say, let's try and help a lot of these people, but at the same time, make a good return on that which you are doing. And I think that for us is what it's all about. If you look at the right-hand side here, this is the number of credit consumers in South Africa, and 10 million of them can't buy a home with the current regulations at this stage in the market because of a impairment in some way. Okay, about 450,000 of those people can actually recover financially, get their credit score sorted, and use mortgage again within 12 to 18 months. So if we can only provide them with opportunities in the next year, we need a lot of money. So I think what we want to do here is actually just show what is the purpose of tonight. The purpose of tonight for you as inviting investors, is to first of all see that what is the opportunity out there, but without doing it in the wrong way, and actually doing it by making impact on other people's lives, but at the same time also make an excellent return with good security and all those type of things. So I think that gives you a big picture of what's happening currently at the moment, and there's solutions needed. And this is the time for entrepreneurs to move. And especially if you're in a position where you have money or credit that you can use for that purpose. So, thank you.
Yeah, just looking at those figures, it's quite actually earth-shattering, isn't it? I mean, just to look at those numbers, and it's really a depiction of what's happened. And but I think absolutely we're still going to get the banks in here, and I think banks have, as you said, they've become less aggressive, and I think we've learned since we started going back to 2009, the crisis of 2008, the global financial crisis. That has been a big lesson, because there we were on a mass sort of decimation.
I just think if you look at, for instance, these figures, I actually couldn't believe it. Tono, normally, thank you, Tono, keeps us all up to date with those kind of things. And when she showed me the figures 6 months later from the last time I saw it, it was at 48 billion. That's 6 months ago. And looking at that crazy jump over the last period of time, you understand that people are in trouble and they need assistance. Obviously, in being helped in the right way so that you don't put yourself in a difficult position.
Excellent. So we've set the scene now. We've seen what it's like, and I think now
Just to
we're
come
going
in,
different
James?
sector. So James,
if
I know you're
if I
watching in the wings there. So James, maybe you can tell us, how is the body corporate and home owners association industry currently experiencing the impaired and distressed market?
Yeah, if I can just link or just compliment Daniel on what he had said, just to illustrate what's going on in the sectional or the community schemes environment. And its community schemes environment is sectional title complexes and homeowners associations combined, which is now called by the different acts as community schemes. In South Africa, we have 75,000 registered community schemes. And with an estimated annual arrear levy requirement in excess of 5 billion rand. Okay, this is caused by non-payment of levies, mismanagement, and an inability by community schemes to access lending capital. I think that just sort of illustrates in what a predicament the housing industry finds itself over and above what Dani had said. If you could just repeat your question again.
Yes. So obviously, you look at those numbers again, like Daniel showed us and like you showed us. I mean, because, the body corporate, essentially manages the units, the homeowners say that's their job, is to look after the common areas, to keep it up, and you've got impairments over there. So now, how is the body corporate and the HOA industry experiencing this market? So maybe tell us, and then also secondly, aligned to that, what is the industry going to do to address the challenges?
Okay, yeah. Look, first of all, you've got to understand that we're drilling into problems here, but each one of these problems creates a huge opportunity for people out there looking for opportunities to invest wisely and securely. Okay, but let's just drill into the problems. First of all, the main culprit in this whole thing is the non-payment of levies in sectional titles and homeowners associations. Non-payment causes huge problems. As I said, at this point in time, we're talking about 5 billion in arrears, and it causes each community scheme or body corporate, it causes a huge headache to the body corporate, in the sense that it causes a shortfall or a deficit on the budget, which in turn then causes the body corporate not to be able to fulfill its duties and functions in accordance with the Sectional Titles Acts. There are 3 of them that they need to oblige to, and they regulate how body corporates need to manage the sectional title complexes. Okay, so they can't perform their functions when it comes down to non-payment of levies, because they don't have the budget to do so. Then, of course, now they want to supplement their budgets by loans, and the banks won't loan them monies. First of all, well, the banks will, provided that the body corporate members and the trustees sign surety in their personal capacities, which no person in their right minds would do. We've also seen a significant rise in non-payment of levies due to in the last lockdown period of COVID. Lockdown. We all know what dire consequences the lockdown had on the socioeconomic situation in the country. That has caused havoc with the banks, with the bonds, as well as with levies. The levies is just the first sign of the problem. That's the peak of the iceberg. When you drill down to that, you see that, okay, the guy is not just behind in levies, he's also behind in his bonds, he's also behind in his car payments, etc. Okay, and then, of course, to exacerbate situations, the only avenue available to the body corporates and homeowners associations is the legal route. where they start legal action against the homeowner and eventually land up in a situation where the property is foreclosed. That had become a extremely cumbersome and costly exercise. Before COVID, we saw that the court roll was on 2 years. At the moment, we're standing at seven and a half years for the court roll. So you can imagine what impediment that causes in the whole situation. Then, of course, there's always the avenue of special levies. But the special levy is an extremely dangerous option to follow. The net effect of a special levy is that the paying levy property owner now subsidizes the non-paying guy. Now you can imagine what chaos that will cause when you resort to special levies in that circumstances to complement your budget. So that must be used as an absolute last resort, and is hardly ever used in that situation, which exacerbates the whole situation. So that just illustrates in what situation, in dire situation, that portion of the property market finds itself.
So we don't want an army of lawyers like we had before, I think in 2008, 19. And it just didn't really get to, I mean, there was a lot of distress for a long period of time. And we've seen now, especially now, I mean, there's probably be a lot of lawyers online. Don't worry, I'll fix it. But it becomes just a one-way fee type of scenario. So maybe the question is, and this is a key question, and what your thoughts are, what is the industry doing to address the challenges in arrears? Because what can we do? What is the solution?
Well, we're not going to have any solution or any assistance come from the government side of things. That we can make peace with already and move on, right? Fortunately, we have a vibrant and very innovative private sector, and the property industry does not lag behind in that regard at all. I would suggest, or I would think that you need a two-tier approach to solving this problem. You need to solve the financial problem of distressed body corporates and homeowners associations, and you need to solve the problems of distressed homeowners to really have a significant impact on the distressed industry. Now, as I said earlier on, that problems create opportunities, and the bigger the problem, the bigger the opportunity arises. And this is where investors need to really sharpen their blades and really look around, because in these distressed environments, there are beautiful opportunities to come on board and really make a good return on investment. The environment where I functioned before taking up an opportunity with the Assist Group is with BC Funding Solutions, which offers financing to body corporates. And then also now with a Property Assist, which is now offers the distressed homeowner the assistance in his problems. Now, to me, there's a huge opportunity right there for me. And when you look at how these two institutions had gone about and developed a reply or a solution to these problems is very unique. It sometimes boggles my mind how innovative South Africans can be. The body corporates, or for body corporates, there's this model now where you can, as a private investor, can invest into a model where you assist body corporates in their fundings, and hence the name Funding Solutions. And with the distressed homeowners, you have assist group coming in and solving the problem, or a majority of problems in the distressed homeowners environment. And in that process, creating opportunities for the investors to get on board and make good opportunities. Now, what you need to understand about this whole concept is both these institutions, both Funding Solutions and Assist Group, had to create a model where it is attractive to the investor to invest in that opportunity. And that attraction surpasses many of your vanilla investments out there. And it really is worth looking at.
Somebody at the door. So I think it's obviously something you said there, James, and I think it's probably the gong just went off, and I think the ideas went flying. That's actually really what. So on a serious note here, James, I think what you brought up, you said something critically important here. When there's an absolute crisis, people get turned creative. We come up with ideas, and we come up with brand new ideas. And that's what crises teach us. We turn anything which is from a hopeless situation into something that we can really turn around. So, and I want to comment, you're sitting up in Johannesburg now. We're going to be there next week for the Money Summit. But also, I'm also chairing, there's an event which is going to be in Johannesburg. And it came off from the spin-off from our residential conference we had in July in Johannesburg. We've got government involved, and the government wants to, can you believe it, in Johannesburg, everybody knows what happened in Joburg in CBD. There's 70, 80, 100 hijacked buildings. 70 people died in a building. 70 people died. Why? Because they were mismanaged. Because, so there's nobody, and they don't have the wherewithal, government, to be able to manage the situation. And we cannot let this continue. And first of all, the reason why we're having the meeting on the 11th and 12th of October in Johannesburg, financed by the Department of Human Settlements. Financed by the department, but now what I've got a surprise for you, James, and for you, James, there's Daniel there and James is there in spirit, is that I'm going to have to get you onto the presentation panel on that particular day, because I think the solution that you put forward here now, both from a distressed individual owner perspective, and number two, also from a distressed body corporate homeowner association, which doesn't exist, of course, amongst our hijacked buildings. It doesn't exist. So we need to obviously change that narrative as well, to first of all say, well, move them all out, fix it all up nicely, set up this kind of structure, and let people move into a house with absolute dignity. So anyway, so that invite's coming both to you, James, so please diarize those 2 dates. You fortunately are in Johannesburg, so you don't have to come down to Cape Town. We have to come up your side through to you. Okay, so moving on. This is a really intense, fantastic discussion. I'm going to ask Gerard now. Gerard, there's always risk of financial gearing. Now, I know, talking to banks, being an investor myself, I heard it was the first one, I think, where Robert Kiyosaki and Dolph de Riz taught me, and they said gearing is like having a loaded gun. So, you don't know where to shoot it. If it's in the wrong hands, you could kill somebody very quickly. So you've got to be very, very careful. So maybe you can tell us, what are the risks of financial gearing in property?
Before Gerard jumps into that, I just want to make a connection there with us. And I think this is important for you as investors. That's online, and if you look at those figures, we will struggle to help so many people, okay, and it's a challenge. But using gearing, using various methods, if you do it right, and I think if we look at our stats and what we've done over the last 10 years, you will see that our returns have been far above what you can do in any normal property transaction through all the different cycles. And I think telling people to get to the point where they can actually use credit, do it wisely, obviously, and that I think Gerard's going to spend some time on. And on the other side, get as many friends as you can, because we can't help enough people. There's too many. And the opportunity is there for us to do that.
Thank you very much. Okay, so back in '94, when I joined the property industry, people were buying houses, people were developing property, small developments, and then just after that, I joined Old Mutual. And when I was taught about investments, I was taught when you do an investment, it's cash. And suddenly, a couple of years later, this new system got developed where you actually use mortgage to buy property for investment. And that is called financial gearing. And I thought to myself, I wonder if people understand what are the actual risks involved when it comes to financial gearing, and to what extent they are exposed. Because this is the model today that we use. And so I just wanted to quickly go in there, and because one must understand that there is a benchmark of what it is to be using financial gearing, and that's called interest rates. And that leads to your cost of capital, how you create your wealth. So, but there is actually a risk involved that I wanted to touch on. So, what is financial gearing? It is all about using a bond to enhance your cash investments. That's the principle of it all. You actually, in very much layman terms, it's buying an income producing asset with money that you don't have. That's what it is. So, thank you. So you are platzak, you've got a good job, and you're going to the bank, and you say, listen, give me some money. Now think about this. Use your credit card and make investments. You say, no, that doesn't make sense. Because what will I buy with my credit card? Stuff that I can use, my bicycle. It will not produce any income. So it must be some underlying asset that this system was geared at. And that is what financial gearing is. So I think at the end of the day, you make the bank your partner. That's what financial gearing is all about. The bank becomes your partner, you negotiate with them, and there's two aspects of your gearing that they look at. Firstly, the property itself, and secondly, you as an individual. The way that you will be able to pay back their financing costs. But on the other side, the downside of it all is, if anything goes wrong, will they be able to recoup their capital? And as we know, the banks are actually the most cost effective when it comes to capital. The rates that we pay is definitely cheaper than compared to individual investors. I don't know if you've loaned money from your family and friends at interest rates. It's not the bank's rates, it's higher. And even if you go for private investors. So the reason is very clear. They are the preferred supplier of loans or mortgages for us. What is wonderful, as you've mentioned, after that crazy period of high interest rates and just craziness. When was it? 2006 and 7 and 8, when people just got, I don't know, with one paycheck they got 10 properties. They just went to different banks. And that changed now totally, where we've got the National Credit Regulator who's actually looking after the banks and making sure that they don't give loans, and actually escalates this issue of financial gearing. And I think lastly, when you tie a mortgage bond to your property investment, you must understand that you are actually bringing risk to your table. And that is very important to understand. So what I wanted to just quickly show you is that, and thereafter, when the property market was so lucrative, we suddenly saw that the banks were willing to give you 100% bonds. What does that do? That increases your financial gearing risk. So the more cash that you involved in your investments, the lower your risk. So what actually, thank you to the banks and the valuators, I mean, they made it all possible, that they could see that there is enough. And I think ultimately the monthly, calculation of your rental returns was close in the vicinity at that stage. You bought many properties that was paid from day one, which is not the case today. And I'll show you some figures but just before you go there, I just wanted to say, one of the biggest things that we need to understand when you do a buy-to-let, because that's what everyone is doing currently, right? A buy-to-let. Let's do a buy-to-let. I want to build an asset portfolio on the back of financial gearing. But first of all, if you're lucky, minimum 20 years to up to 30 years. That's your exposure. So I've done a couple of numbers on a buy-to-let. On R1 million bond, we worked on a straight 11.75 interest rate, 20-year term. Daniel said we can get a bit of higher, but I was in a meeting a couple of months back with a property owner. He negotiated an 8% annualized rental return. So 8% of R1 million divided by 12 is your monthly rental that you'll be getting. And after putting all those figures in, a monthly shortfall of 5,998 was still from year one. So your increases will come afterwards, so it will reduce a bit. But we also included some of the costs there, and I just gave you the figures because the next slide will be a bit busy. Included cost of rates and taxes of 516, levy of 750, insurance of 200 rand, property management of 467, and we've allowed for no maintenance. We presume this is a new property. You should be fine for the next. Let's see how long you hope that you will be fine, because if you do look at the next slide, you'll see how long it takes for a property like this to get break even. Now, break even is when you have a positive cash flow, taking all your costs into consideration except for maintenance. And in this case, on an 8% rental return, it is year 13, which is actually shocking. So I was speaking to a client today, and he said to me, "No, I'm not going to put 50% into a rental property in the Cape, to cover my, be cash positive from day one." I thought to myself, let me just do it on our side quickly for the figures for tonight. And the reality is you will have to put in about 450. If you can push your rental return up to 9%, you can put in 300,000. Then you'll be cash positive from day one.
I just want to help the guys here. So he's been very nice to this spreadsheet, because if you can get the 7.5% increase, if you can get a 7.5% increase on a rental today, please phone me. I also want to invest in that area.
Thank you, Daniel. Yes, so the reality is that we did make it, a bit better than it is reality, because that means that if you look at your financial gearing, and I think that's what I wanted to explain from a cash flow perspective. Your agreement with the bank is, please pay every month and for the next 20 years, and if you do that, I won't take your property. That's fine. I don't know if how many people has actually lost a house when a bank came and said, "Listen, I'm taking it now." I have. No. In a trust of ours, after that.
Only about 25.
Yeah, look at me. Okay. But the reality is, they have real teeth. The small print that we just sign off, when it comes out, when you are defaulting on your agreement, it is a real problem. And after 13 years, the banks will come to you and say, "I'll gladly take your property because now it's worth much more. And you owe me much less. But thank you very much. Sorry about your defaulting, and sorry about losing your job." So it doesn't make a difference. So what I'm actually saying is, and I think the next slide is proving it, is that you are in it for 12 years before you break even. Secondly, that sum total of your shortfall over the first 12 years is 498,700. That's what you'll put additionally in to break even on this property. And then your agreement is still 8 years left up to the 20 years, which is even a worst case scenario, because now you're starting to get positive cash flow. But if you should, and as I was explaining to my colleague today, the monthly rental in year 13 is 15,000. So suddenly you lose your tenant, suddenly you lose your own employment, and you are required to pay in. 6 months later, you become part of the stats on slide 1. You don't know about assist. There's no one to save you. Then the banks come and says, thank you very much, I'm still going to take your house. And you've been gearing yourself to actually have a good investment for the long term. So I think the reality is, after reaching break-even point, the risk of the asset being lost is still possible. And that you need to understand. The bank has a superior right because they used your property as security up to the 20 years or the first date of full payment of the loan. And people don't realize that. So gearing is a game that works well to build wealth, but understand that it needs to be managed, and you must be really proactive in doing that, because the financial method of building wealth is one that has serious teeth, and you can be vulnerable up to the full term of 20 years.
You just need to ask the bank for your title deed. We'll see whether they give it to you.
They won't. So basically what we do from Assist side, and that is the solution that we also would be advising on. Use bonds conservatively. In our case, you know that we never go higher than 75% loan to market value, all cost including, and shorter terms if it's possible. Now in our case it is. We on average it's 2 years, then you're out of a deal, and your returns are actually compounded. You reinvest. It's a different model, but the reality is the second point is really true. Cash is king on all bases. When you're gearing specifically as well. So the more cash you put in, the lower your financial gearing risk. And so what we are doing is we're saying, listen, we're going in conservatively with bonds. We realize your profit. We reinvest and lower your risk while you're building this asset portfolio. And lastly, I would say partner with the right co-investors. So if you are exposed to pay 15,000 rand a month on one flat, and you are one, and you lose your job, it's going to be quick. The banks will take you out. But if you are three, your two partners will be able to say, listen, we'll subsidize your third, which is 5,000 rand, for 6 months. You owe us 30,000 rand, and when we sell this property or refinance it, you're going to pay us back our portion of. So you spread the risk, and so we do quite a bit of co-investment. And I think from our side, if you want to become wise, without any doubt, become a partner with Assist Group, because I can tell you now, you are cash positive. I've done the figures and I can show you, but because of time, we won't go there tonight. We are cash positive from day one. You can co-invest whatever you qualify for. You will be able to apply, and we've basically done. I always say when we do the risk committee meeting, which is 6 to 8 people, legal, finance, planners, the actual property risk, the maintenance guys, all of it. If one of us don't sign off on a deal, it's not a deal. Everyone needs to sign off. So by the time that our investors get exposure and it's published on the website, I can tell you now that we've looked at the risks on juristically every aspect of it, and you will have, so earning the returns that you do get from us with the level of risk that what we expose you to is actually a super return in my mind. And that's what I just wanted to quickly touch on tonight. Financial gearing is something that we must use, but be very wise in how you do it, because it is a long-term commitment with the bank.
Excellent, Gerard. I think you've opened up a nice just giving some really sound advice. And I think you made a very important point. The one is make the bank your partner, because I think at the end of the day, banks are negotiating. Remember, they also at risk. They look at the risk. Bank says we are not in the risk business. Okay, so just understand that. So you hit into a situation where you can't actually afford your payments anymore. This is the opportunity. So it tends to be quite limited as was explained by Daniel and by Gerard in terms of what those options are. And that's why I think, Daniel, you can take us through what are the solutions offered by the banks and Assist Group. And I know that the banks offer a lot more than they used to, because there's been a lot more distress, there's been a lot more downturns, financial crises, and with that it creates all different kind of programs. They moved from, instead of auctioning your property to moving it to estate agents, which is a longer sales cycle, to a whole lot of other different things. But I think at the end of the day, we need to get to a win-win. We need to know that. So Daniel, it's over to you. Tell us what are some of the solutions by the banks and also by the Assist Group. Yeah.
Couple of questions online. You want to take them in the section?
I think let's take it all at the end. Let's get the presentation done. We will take your question. So, and we will rewind back to where we were. So we just want to end off on the formalized side on the presentation. We will get to Q&A. There's a lot of time, ladies and gents. Yeah. Okay. All right. Can you, is that a bit better?
Your right side of your laser.
Okay. All right. You got it. Can you hear me now? Right. Good stuff.
Thank you.
Okay, Daniel, over to you.
Yeah, so I think just to end up or start where Gerard ended off, I think important for me is that I've dealt with many real estate investors in the past, and I remember those days I had an investor who's been advised by, I would rather call it training companies, because it's not really always giving you theoretical advice, but it sounds great, and they say, no, use every credit ability that you got, use it to the max. And I would not forget that guy he actually sold a farm, and he had a lot of money coming from the sale of that farm. Can't even remember the figures, but I know he bought about 38 properties in a very short time, geared it, bought some more, and kept on doing it for a while. It was going well with a low interest rate and growth and all those times between 2004, 2008. And I remember one day he just phoned me and he said to me, listen, can you help me? I said, well, what's the problem? He says, no, now I've got problems. I'm stuck with these properties. I've geared them too high. And literally, most of his money went down the tube. I mean, that is very unsound practice. I mean, I think out of the properties, he probably visited, 7 out of the 38. The rest he bought online, type of things like that. And I think the challenge is, when you do a good investment, you have to do your homework properly in real estate. You need to look at this stuff. I don't care who gives you the property, even us. Just verify all those things that we've done. Okay, we make it so much easier for you, but you still have to do that. Okay, and I think if we look at the banks, and one thing that Gerard specifically mentioned about the 15-year story and so on, and that's actually true. We experience that a lot. I had a meeting with a real estate owner recently, and I ended up, and he said to me, we lived in this house now for more than 15 years. We have got a low mortgage. At a stage, through difficult times, we lent some more, and now we stand to lose that property. Okay, and I think that for me is obviously a great challenge. I think the situation is that we must understand we have to deal with those owners. They've landed up in the same position, and that's basically what happens. They paid off their property for a very long time. They had equity in it. Unfortunately, went through difficult times, go and borrowed short-term money, all kind of things like that, and ended up in that situation. And that's what we want to stop. I always use this term, and I say, when people stop burning houses and buildings, when you own one. Okay, so let's put people into home ownership. Let's make sure that we keep people in their homes, because it's a stable environment, is what it is. And on the end of the day, it will just be beneficial for everybody in the country. For you as the investor to make returns while we're doing that, and for that client to keep his social fabric in place, his household in place, those type of things. We know the divorce rates are 50% of them is financial. So, and one of them, I mean, we've been in many meetings, and any who's here tonight as well will tell you, he, on the end of the day, he sat with a situation where he actually, where the client says to the husband, if I lose this house, I'm gone. So I think that's the challenge. I just want to help Christian here and Christoph here. Getting them online here. Those guys online, just give us a moment. We just lost our picture here inside, not, I think, online, but...
What we can do in this interim period is let's maybe...
take some of those questions.
Let's take some of those questions. Would you like to relay some of those questions through to us? Okay, question.
Okay, so the first question is from Gerald van Rensburg.
Right.
In your professional opinion, how long will the market remain distressed for set group of distress scenarios?
Okay, who wants to, I mean, I think we've all got a view how long it's like how long is a piece of string? And we never know. The one thing is don't get into any sort of predictions and what in terms of how long it's going to be. I think that's a very sort of risky move. And I think you've got to de-risk yourself, whether you're up or whether the market is up or down. Just remember that we go through cycles, and cycles go up and down, and the market recovers in fact, I would say every 10 years, there's some form of recession. I mean, we remember we had, in 2000, we had the dot bomb, and I don't know if you recall, in 1998, we had interest rates at 28.5%. I mean, can you believe it? People were running for the hills. Imagine, I mean, we're talking today, interest rates are at currently, is it 11.75%? That was almost 20, I think it was 25.5. That was in 98, July 1998, 25. Now, who in their right mind can fund, we talk about there's distress in the market and all that kind of stuff, can do that. Then we had, of course, the dot bomb, and then we had the global financial crisis 10 years later. Then we had the pandemic. So all the time there's something, so it's very difficult. All we got to know, we got to plan for the ups and for the downs. So it doesn't matter whether the market you have to predict. So don't try and time the market in any way. And I don't know whether I've answered the question directly. I mean, you're welcome to just comment, and I'm just going to deal with this question, and we'll get back to you, Daniel, on the different solutions. And maybe just, is it Gerard van Rensburg? Sorry.
So it's Gerald.
Gerald, eh?
Okay. Gerald van Rensburg.
And Gerald, are you happy with the answer, or would you like us to elaborate a bit more? And I'm happy to get, Daniel, do you want to give a comment there?
Yes, I think, look, you can listen to 7, what do you call them, economists, and you'll have about probably 14 different answers. So I think it's difficult to answer the question of how long. I had various discussions with, and we do it often, with guys who really know the industry and predict well, and like Erwin Roders and those type of guys. And I think the timelines is, as Neil says, is not the answer. Your answer lies in finding opportunities. If we see how the market has been affected over the last, call it 5 years, with regards to returns on property, I mean, we never knew growth of 3.5% a year and things like that. I mean, we were seldom under 7% per annum capital growth. Plus, you have normally a 9 to at least 10% net yield. You know, so your good returns was about 15% per annum, easy. You know, now we had, if you're very fortunate, you may end up by 8 or 9% net yield, then you're doing very well on residential property. But there's various opportunities out there, and that's the key. Find those people who's innovative enough that can provide solutions and returns on transactions, which actually provide you above average and above inflation and all those type of returns. That's what you should be looking for, instead of looking for how long is it just going to last. I've got a good friend who always says, use the opportunity within the lifetime of the opportunity. And I think that's the key.
Great, we got that back. Okay, so I think, Daniel, we're going to continue just to look at the different solutions. And then I think we're going to come back to the audience, and that's both our live audience and obviously our virtual audience. We're going to deal with your questions. So over to you, Daniel.
Thank you. Yeah, I think just first of all, the first problem that we find in the industry is as soon as a person is in trouble, he starts avoiding the bank. The first thing. For whatever reason, I don't know. I know they harass you, and they know it, and that's their purpose, to actually get you to pay, and therefore they don't have to harass you anymore. So the point is, in this case, they are always the less costly solution. The banks are really trying from their side to go out of their way, and I'll deal with them quite often. And I can see that if you look at these things, which we're talking about here, with regards to payment plans, restructuring options, mandated sales, which you spoke about, that type of thing, they have really got quite a lot of things, and they've improved it over the last few years. You know, they've constantly had new ideas, and they're also getting innovative in finding solutions instead of going to sale and executions, because we all know that's not the answer. And I think that is what I like about the approach of the banks these days. The key point, less costly for any homeowner to do that, or even if you are going through a difficult time now, make arrangements. And while you're making arrangements, you deal with it. Obviously, when it comes to the point where you have failed to keep, rather makes, if I can call it, less aggressive commitments, because the moment that you don't keep to them, the bank takes action. That's unfortunately how it is. Another tip for any real estate owners online, guys, never go into this whole thing about, but you know, the bank have overcharged me. Yes, I know all those things. It's beautiful. And they actually are selling their debt behind, you know, and to other people. And it's all things that you can lean on. But there's a very simple principle. Did you lend the money? Yes, I did. Okay, so then pay it back. You know, so I think those type of things is very important for us to keep. Now, if you look at what is the different advantages, if we look at from a homeowner's perspective, how are they helped through the banks? Okay, less, as I say, less costly. You buy time on the end of the day to resolve these issues, and the bank are obviously keeping you as a client, and he's getting assisted in the process. The bank resolve their problems and he gets assisted, and they keep a client for very long if they actually do that. Then obviously on the bank side, they limit the legal process, because then if there's other solutions that they find, they don't have to go through that process. And obviously that is an important part of the solution. So if we then move on to different types of clients, which we will touch on. I think is very important to work on those different types of clients. If you look at this client, and I ask you, if you're an investor, will you help them? Do you think you can help them? Come on, guys, share a bit.
Again, I think start and look at the ladies and just we need to help them more than just run and 50.
Yeah. Most people would walk away because they can't help him. Now, typically, the type of product we talk about here is what we call our rebound solution. So, as an investor, you will be looking at purchasing the property at values of 60% of market value, which I think is quite good, with the whole purpose to flip it immediately for a profit. Predetermined profits of 70% plus, due diligence and risk already mitigation done for you. Those type of things. You look at the transaction facilitated by Wealth Assist, the whole transaction is done by us. You're making a social impact, which is very important on the end of the day, by helping the homeowner, even if you don't are able not to help him to keep his home in this case, because everybody is not recoverable and we must understand it. But it doesn't mean we can't help the client. Okay. So in that case, what will happen with a homeowner? We have a discounted mortgage debt. Now, with a rebound product, the banks are even prepared, they sometimes write up to 40% of the loan amount. Okay? So those type of things are important. Always getting something out. The client always get cash out. Now, if I tell you that your mortgage is the same amount as your the value of your property, how much money are you going to get out? Nothing. We had transactions where the client owed 2.2 million, property was worth 2.4 million, property was worth 2.2, client got out 250,000 cash to start afresh. That's the type of transactions that we do. But you are part of that process as the investor to actually make that happen. Then you look at the bank, what's the advantages for them in the process? Why would they do these things? They limit losses, avoid legal action, predetermined discounts, so they know I have to write up this amount of money instead of going to an auction where it may be that I end up with 35 to 45% of my debt covered after all the legal costs, the timeline, all those type of things that goes with it. Okay, different type of client, has no equity, as we can see there, but and no income. So on the end of the day, how can you actually assist this type of client? He's got equity, has equity, but no income. All right. So in that case, we've got product range. They can also not keep their property, or in some instances, if they owe, I'm just using a simple example, 200,000 on a million rand house. Then there is, and now the guy lost his job. So we built in the transaction the first year's returns, rental income, okay? That lies on trust. So you covered as the investor on the end of the day. Then in that case, it gives the client the chance, or the real estate owner the chance, to actually find a job, resolve his credit score, sort out these things, and keep his home. Okay, so those are the type of things which we're looking at here as the different solutions. Again, you as an investor, we never buy properties or for you, on behalf of you, for more than 75% of market value, all costs inclusive. Then obviously you also sell it for profit. In this case, you sometimes get a lower fixed predetermined return, but you share in the proceeds. Okay, so that again is a benefit for you. We again do the DD for you, the due diligence, the mitigation, run the transaction for you during that term, appoint the agent. You literally do very little yourself. And especially if you are credit rich, cash rich, and time poor, this is the perfect kind of model to fit for that purpose. Your homeowner on the other side, again, buy time to stay in that property while he's waiting for the property to be sold, to get a discounted mortgage and creditors, other creditors, etc. Always getting something out again. And what they do, as we know, guys, if you sell a property on a sale and execution, and he owes another 300,000, the banks sell the debt, and those people come after them, and they collect it. Okay. Where in this case, when he settles it up front, you actually know up front how you can stop this. You know, this is my debt, and the banks negotiate with you. They sign an acknowledgement of the debt for 10 years, 1,000 rand a month, or whatever you can afford, and that is a much better way for everybody in the process to actually do that. And obviously, the bank have got the similar kind of advantages. And I think a very big one is through these solutions, we literally help the bank within 2 to 3 months. They'll have the money cancelled, the bond cancelled, whatever the case may be, and be assisted. And at the same time, you as the investor have an investment with the proper below market value type of thing. Then you have got the clients who actually can afford to recover, which is very important. Those are the guys that can keep their homes, that got a consistent income per month, have got a fixed job, that type of thing, so they can afford to actually recover. So we pre-qualify them up front, making sure that you can be assisted in the process. And in that case, the property will be purchased by the investor. He signs a lease with a net rental of at least prime +2, which means you will be cash positive from day one, even if you don't put 1 cent cash into it. And you just use your credibility. Okay? So you never will have less. And because it's a triple net lease, you will always, as an investor, have the maintenance, the rates and taxes, the levies, all those type of things. If it goes up, the tenant pays it. All right, that's what the triple net lease means. Okay, so you are geared against those risks and mitigated all those risks in the process. Same story, due diligence, transaction. I'm not going to spend time on that again. And obviously the social impact that you make, help by people keeping their homes and staying in their homes at the end of the day. You have a homeowner, provided peace of mind. You stop the social and financial distress in the family. Status quo, stable environment while they're fixing their credit score. Discounted mortgage creditors. Obviously, a lot of time in these cases is because there was other debt raised during the term, short-term debt, that type of thing. So we will negotiate that, settle that debt. Sometimes the bank even have to take a bit of a haircut and that type of thing to sort it out. And obviously, from the bank side, same kind of principles that we just spoke about. Then one of our unique solutions, you have a lot of developers or even guys who don't feel so positive about South Africa and they want to run, sell everything, have large portfolios of property, want to offload quickly. Then in that case, we can buy those properties at discounted values and from developers who actually sits with a lot of stock that is completed but are not sold. And most of those development bonds that they use have got a time limit to it. And when it gets closer to those times, that's the time when we can buy those, and we buy it again at the discounted value. And on the end of the day, provided to that, you remember that 10 million of guys who can't actually get credit at the moment? That 450,000 of them that can actually get approved within about a year to a year and a half. We work with those 450,000 and we sell those units on an assist to own basis to those clients. All right. So, so that I think ends us up with a point where we know what can we do as an investor to contribute. What is the advantages of it? All those type of things, instead of misusing people's misfortune. Take his house, throw him on the street, and there's no benefit in that. You can still do a transaction with a client who's willing and prepared to work with you, where you, on the end of the day, can make a social impact in his life and a financial impact in their lives, and you have an excellent return with good security at never higher than 75% of market value. I think that's the key.
Excellent. Good. And I think let's move on now to, because we got to the point now, I think where we need to open up to the floor. And I think this is where we're going to have the panel discussion. So we've got our live audience here, we've got our virtual audience, more than 200 of you, I believe. and all standing out on the other side. So we're going to get lots of questions. And so maybe starting off with the audience, our live audience here. I don't know if we're going to get the mic runner. Get the mic runner just to give the mic. Is there anybody that wants to have a go? Please, everybody, not all together right now. You know, we say we're going for questions. Who's up for any questions? If you had a question, what would it be? If you could just take the microphone, please. Just your name and then the question. Right, thanks, Jared.
One of the questions is that, say for instance, you've got a little portfolio, would you sell your more expensive properties now and invest the surplus into something like this? That's the question. Even though your gearing could be low.
Thank you. I was just wondering about.
Right, I'm gonna hand you my microphone so that you can.
Very good question. I love that. I'm a property guy, and a property person don't really like to sell their properties, and I do understand that. I think for me, what you can do, what I would do if I'm in your shoes, I'd rather put it that way. If you're obviously looking at your portfolio, and you have to obviously update your portfolio on a regular basis, making sure that you're positioned your properties in the right places, etc. All those types of things. But let's say that is the case with you. Then in that case, if you've got an existing portfolio and you gear against that portfolio conservatively, then I would rather go that route. Because now what a lot of people don't understand, you build up this portfolio and it took you time. Let's be honest, it just doesn't come overnight. And a hard slog, rent tenants that didn't pay and this and that and all those type of things. And now you end up and you have, let's call it, I'm just going to use figures. We've got a 5 million portfolio or 10 million portfolio of properties, and you owe very little on it. You owe maybe R1 million or 2 million or nothing on it. Now, that means you can actually keep your properties, gear on those, use that money, invest it wisely by getting good returns, like in our case, call it 17%, where you get prime plus. So it won't cost you a cent to keep them. Not a single cent, because the income on the right product will pay for it from the start. Now you're getting on that money, you get growth of 17% per annum, but at the same time, your capital growth on your property continues. Apart from, so you're losing a bit of your cash flow, if I can call it that, on that side where you would have got all the net proceeds. And then in that case, you get growth on that 10 million plus on the 5 or 6 million that you borrowed and increase that. So you're actually getting returns now on the total instead of that's the one part. And then secondly, that goes with that is obviously if you've got certain selective properties, which we all know certain type of price ranges are far difficult to exit than others, I would identify those and I would tell them if I think it's really becoming a risk. If it doesn't, I would still be comfortable to keep them. That's just my input on that.
Right, we had another question here. We'll get to you, the audience as well, the virtual audience. Your name and then the question.
Kevin, I was just a matter of interest. When you look at the different products and you decide what product to use for the type of investment property that you've now identified, and you look at the persons that you're now going to do the deal with, who's going to stay in, purchase out or whatever, how do you determine the psychology of the people that that they're going to stay in the long term? For example, the first product. How do you identify that this person is suitable for this product or that person is suitable for that product? Because I think you're from personality, you can pick it up from the beginning already, from the history.
Yeah, it's interesting. I think there's two ways. The one is we've got a division called the financial wellness side. So we actually work with them on a monthly basis. We train them because there's a reason why they went into distress. And in some cases it's actually traumatic in a sense, but in other cases it's just bad discipline. So we put them through, and for the whole process of 18 months on those typical clients, we try and we take control of some of the aspects of their finances. We teach them about debt and that financial wellness. It's almost, I call them we're not using debt counseling as such, but it's the same principles of saying, listen, how do we recreate, your mindsets about this? And I think the second leg of it is our agreements. So by agreement, we forces, they might not understand it all up front, although it's very well explained by our people. The reality is, when there's something happening that's actually detrimental to themselves, then we actually make them aware of it. We explain to them in the agreement. We explain the effects on the investment decision that was made because of what they committed, and then we can respond from that perspective.
Just on that as well, we've got on our master agreements, just what he mentioned, just a very practical sense, for instance. If the client pays before the 1st, you get a discounted rental. If he settles and recovers and purchases property prior to the time, we're actually just busy changing our master agreements so that he can get a discounted value then of buying back his property. So the motivation is there, and then the management of it, first of all financially, and secondly, if I can call it attitude-wise. Because if you go through a difficult time, you must understand that the client has gone through a difficult time, and it's not always the person's fault, whatever the case may be. So they need to be, you need to walk a road with them to get him out of the negative mindset in that case. And that is part of our program, which is always built in our transactions. You will actually see that we budget for that 2 years. Yeah.
Great. Some more questions from the virtual audience over there. Christian, could you read us some of the questions there, please?
Okay, we've got another one here. Who controlled the deed to property in distress if you invest through Wealth Assist?
Okay, it's a normal transaction. I like he asked the question in a difficult way. That's why, but it's a very good question. Any property, this is like buying any other property that you buy as a buy-to-let or whatever it is. You're going to either buying it by transferring it into your name or your entity's name or whatever the case may be. So that deed goes onto the investor's name. All right. So you own that property. Even if you buy it at 50% of market value, it still goes on your name for that price. Okay. Secondly, if it's an installment sale, the recordal gets recorded on the title just like any other Alienation of Land Act transaction. So it works like as if you're owning that property and you are owning it, and that client is the tenant for you for the term with a predetermined purchase price. That's the only thing that differs.
I can just maybe add my portion. The other day on the rebound transactions, Daniel said to us, but the attorneys will actually be holding the deed in the office. I thought to myself, really? It's not on the movies only, because I've seen the deeds on the movies, but because in my mind we always used finance, so we never saw the deed. But when it's a cash paid property and it's coming with the banks and et cetera, it's actually held by the attorneys. So I was, that's why I was a bit hesitant to answer.
Right. Next question.
So we also have here another, and perhaps James can be of assistance. The question is from Theo, and he says, how does an investor earn a return from the assistance that Wealth Assist gives to distressed body corporates? Please give an example and also indicate the potential returns that can be realized. And this said in brackets, what is the rate of return?
Well, James, I'm so glad you got your question. We thought we lost you for a moment. We're so glad that you're still on. James, did you hear the question?
Just pause it and run it by me again, please.
All right, no problem. The question is, how does an investor earn a return from the assistance that Wealth Assist gives to distressed body corporates? Please give an example and also indicate the potential returns that can be realized. What is the rate of return?
Okay, let's start off with the rate of return. That's the easy part of it. Then I'll drill into the rest of the question. The rate of the return depends on what loan product or investment product the investor is interested in. There are 4 of them, but the rates are prime plus 3 and prime plus 5%, which in other words 11.75 plus 3% and 11.75 plus 5%. Okay, those are the rates. Okay, having that behind us now, how do you help? It is if, for instance, a body corporate requires a R1 million assistance, then the investor will then lend in very short. This is far more complicated than I'm sketching. I'm really putting in the tip of the iceberg here, just to give you a guideline on what it is. If you want to know more about it, please contact me personally and I'll delve into it. It's about a 2-hour session that I go through with you. I think Dani would fall over backwards if I had to take 2 hours to do that now. So what happens in essence is that the investor theoretically loans the money to the body corporate directly. Okay, at those watch names. It is facilitated and it is regulated by BC Funding Solutions. The mechanism involved in that is a financial money moving institution. So that the paper trail, well, when I say money moving institution, it is an international money moving institution apart from the banks that creates the paper trail where this transaction is done. The contracts are compiled by Werksman's attorneys. So you sit with a very decent contract. Werksman's is one of the largest attorney companies or firms in South Africa and also significant in the world. That is in short how it works. Does that answer your question?
Yeah, look, I think you've elaborated, and it's very difficult to reach out directly to get to.
Of course, yes, yeah.
But I think you've actually opened up very nicely, and I think you've articulated it very clearly for anybody to really understand. Okay, next question. Have we got another question there?
Yes. So the next question is from Gerald, and he's asking, is it better to stay in debt longer or pay the asset off quicker for tax purposes?
Yeah, look, yeah, and I don't think there's a right or wrong there. It's a very difficult one. I think it's also an individual propensity to risk. And I think that's what it really comes down to. And I think linked to that risk would be what structures you would buy it in. If you buy it in your own name, you're obviously more at risk. If you buy it in a trust or in a company, you're at less risk. So I think that would be the very long and short. Yeah, and look, I mean, there's also got to be, if you're going to invest with risk, you've got to have some access to some kind of finance. You know, you don't want to be sort of, as Gerard said it so nicely earlier on, platsak, and you're starting to get yourself into heavy risk there and taking on, big sort of bank finance, and you can't finance it, and you're reliant on solely on the income of that particular one. So I think that'll be the quick and easy one without passing on to the rest of the team. Next question.
Thank you. The next one is from Anonymous, and the question is, do you invest in your private capacity or can you invest as a trust?
Okay, that will be for you, Jens.
No, it doesn't matter. No, you can actually use be in your private capacity. You can use a company or a trust structure, depending on what you've got available and ready to use, and what your long-term aim is, and so on. We had on the previous webinar. You can actually ask for the link. We had an attorney discussing the different options on specialists. We actually had a meeting today with him, and when it comes to these things, we involved the guys that can actually give you the advice.
Okay, great. So the answer is yes, and you want to see that video. It is online. You can go to the REI website underneath education, event replays, and you can see it there for free. Next question, please.
With the current credit consumer status, what is the risk of investing in a property, getting a bond, foreclosure have to take place, and you can't get the property sold to get a return on your investment?
Great question. Thank you so much for that. Yeah, I think that's probably the main risk, is what happens if the worst happens. You know, if you can't get your property sold. And I think that's where you have to get innovative, first of all, that you can change it. I think it starts with making the right valuations in the beginning. Now, to use our products as an example, and I'm not just using that as to say this is the only solution. There's lots of solutions. But in our case, we have what we call 3 values. That 3 values includes obviously your normal market value, which is a professional valuation that we do from objective, professional, qualified valuers. Okay. Then you have your what we call a quick sale value. Okay, or when you list your property, you list it at the listing price. We have got predetermined prices which offers we can accept. Then we have a quick sale value, which after 2 months we drop the listing price and we can drop it to that price, which is normally, and through the experience over the last 10 years, literally I had 2 properties in total that didn't sell in that time. Okay. Because we do our transactions for 12 months. And if you can't sell a property in 12 months, there's something wrong. Then you bought wrong. Okay? And that's why I'm saying, if you do it right, you do your valuation part right, especially on our flips, we don't only do the professional valuations. We even do the specialist. And this is kind of stuff that you need to understand. If you appoint any agent and you hope for the best, you're probably going to get stuck. Okay. If you determine who's your area specialist, you know, we've got a standard form that we ask the agents to do the assessments on. That standard form says, how long will you take to sell it if this is the listing price? What is the days? Why do you say you can sell it for that? What will you take if it sells for 90 days? Okay. Give me your actual sales in the area over the last 6 months, because you can't call yourself a specialist if you sold no homes in that area or one. That's not a specialist. And that's where a lot of people go wrong. They appoint the rates. No, I've got a friend that's a nice, love them, bribe with them, do all those things, but appoint a specialist.
No, good. I think it also raises the whole question of sort of area. We've seen massive immigration to the Western Cape, areas like the Western Cape, and you know, generally, if you're going to buy here, you're going to do all right. And you know, we're talking also about areas like Mossel Bay. We're talking about George. You know, those kind of areas have also benefited from there as well. But we're also finding, because the market is, you know, it's a little bit skittish in terms of bank getting finance, we find that there's 20 people lining up for a rental. So you can join the queue in Cape Town if you're looking for a rental. Be one of the 20, make your bid. And it's a true story. That's what's really happening. It just is, demand has picked up to a significant level over here. Right, next question. All right, and I'm going to take a couple more before we do our closing off, yeah?
Yeah. And we got one of our popular ones, which is, what is the minimum investment for the BC funding?
Okay, that's who wants it? Gerard?
The official number is 100,000 Rand cash. But Daniel always waives the 100,000 to say we will assist anyone. You know, when it's a cash investment, I think from a bond perspective, you know, lower than 250,000 is not, you know, always worthwhile. It's difficult to assist, but I mean, 100,000 Rand cash and 250. But speak to us.
Next question.
Right, then there's another one. It's a little bit longer, but I will do my best. From Justin, we have a question. Good evening. Does Assist Group have a program if a homeowner has passed away? The children inherited the property, however, they cannot afford the bond and the estate needs to be wound up and property transferred. The property is in arrears and banks are on the edge of taking action, auction in this case. Is there a program where Assist Group could get the bank to discount the arrears or bond by a large percentage, buy the property and give the heirs or sellers the option to buy it back within a 2-year period?
It's a very good question, and yes, there's lots of challenges like that, where unfortunately the parents have maybe not had enough insurance or whatever the case may be, and there's still mortgages left and the children was left with it. I think in their specific case, please ask them to call me personally and set up a meeting, because it depends on what the structure is, but we can reverse, I don't want to use that word actually, reverse mortgage, but where we can actually purchase the property, give them time on the end of the day to recover and keep the property, depending on how old are the children, how long are they still, are they actually working and employed, or are they not? All those type of things. There's a lot of things that need to be taken in consideration. So, but we definitely have to help lots of people like that. We will also help them with the whole transfer process from the estate to their names, and from their names to an investor's name if it's necessary, and all those type of things. Okay.
Great. Do we have any more questions? And if not, I'm going to, is there still
We
one?
can take one more.
We'll
Then
take one more.
due to
And
time,
then
we'll have to
also, if
close.
there's somebody from the audience here that would like to pose a question, if there's a question at the back there, so we'll give this to that gentleman. We're going to make that the last. This is the second last, and then we'll close and wrap up. Question, please.
Thank you. Last one from our online audience. Does Wealth Assist only assist on distressed residential properties or with commercial properties as well, like office parks or office units?
Okay, good question. We do commercial, we do industrial, but if it is offices, I can tell you now, then it's going to be very conservative. If we do that, and only up to a level not higher than a 20 million building and that type of thing, because obviously working with the type of investors, we don't want to combine stacks of investors on one transaction.
Great, and I think there's a great opportunity there. We got one last question. I'm going to give our wrap up, and our audience, please hang around. There's going to be something that we're going to announce to you, interaction with Gerard and Daniel next week in Johannesburg. Question, please, your name and your question, please.
Jacques, where do you guys see the most distressing coming from? Because a gentleman mentioned that people are moving to the Western Cape, but that doesn't necessarily mean the distressing is here. And are there areas that Wealth Assist avoid?
Yes, so that's a very good question, and I mean, all you have to do to get the answer to that is to make a few calls to a listing agent. And if only in Johannesburg, you'll find there's an exceptional amount of listings in Johannesburg. You can also monitor them even online on Property 24 and all that. And I mean, some of those properties have been on for a year, 2 years. Unfortunately, there is a mass migration. People are either leaving the country or they're semigrating to other areas where they're getting better services. Most of the people that are leaving cannot sell their houses because the market is just not strong enough to be able to sustain it. So what happens is then they turn that into a rental. So they normally get their rental returns. I mean, I've got family, they immigrated to Australia. They came from Pretoria. They still have their houses all on the market. They still haven't sold. That's, and there's a lot of those stories at the moment. Unfortunately, the fundamentals of the Gauteng market is very poor right now. But it also means that there's good bargain prices. So it depends how you see it. Remember, every market will always recover. And it's never, ever, ever, ever going to be forever. Nothing is forever. Just believe that. So I know we're living in a good time, better times in Cape Town. There's more demand. There is a shortage of properties, in fact, in the Western Cape right now. There's a massive demand for Airbnb, student accommodation, all the short-term rents. Yeah, and so that's where the biggest opportunities, besides, of course, what is offered here tonight by the distressed market in terms of the returns that you can get on individual properties with Wealth Assist. Those are the opportunities. And if you sit with that, then it's really good. Okay, we've got on the screen a partner with us now. I just want to, you can probably use, for those of you online, you can probably, just use your phone quickly, schedule a consultation. And I encourage you all to reach out both to Daniel and to Gerard, to call their number. There is the consultation over there. And as you heard, I think it's very professional. I think it's a fantastic product you've got here. As I said, Daniel, we have to send you up to Johannesburg to talk to some of the municipalities and developers who need your help, who need your product. And I think you can play a valuable role there. And James, I hope you're still there. We're going to include you in that as well. Certainly from James, are you still there?
Yes, I am.
Yes, good. James, maybe you want to just give us your closing thoughts, your closing comments after today, because we are getting to that sort of closing part of the presentation. Just your last 2 minutes, leave somebody with, leave the audience with your sort of takeaway notes and what they can do and implement in terms specifically in your area of expertise in the homeowners associations and certainly in sectional title. Do you want to maybe just leave us with your final wrap?
Gladly, thank you very much. I think it'll be far less than 2 minutes. All I have to say is that now, like never before, the opportunities are great out there. Distressed situations create opportunities. And speak to the people that are involved in these distressed situations. Pick their brains, do your research, and you will find that you'll stumble onto but you'll see opportunities. You'll find opportunities that's really, really worth your while, from a investor's point of view.
Excellent. Okay, I'm going to ask you to give your. Thank you very much, James. Thank you for joining us. We're going to be chatting soon. You want to reach out to James, you can also reach through the Assist Group officers. They are partners in certainly and adding a very valuable partnership, I think. So Gerard, your final wrap, and then Daniel.
Thank you, Neil. The one question was, how long is this distress period going to continue? I can tell you now that the high cost of living is felt by everyone, as you know. It's the high inflationary environment still for the next year at a minimum. I think the reality is that people are struggling, and people have overexposed themselves very much so on the short-term debt side as well. And I can assure you that there will be, sadly enough, quite a bit of investment opportunity for many individuals that is ready to take on this market. So thank you.
Thank you, and thank you, Neil. Appreciate the opportunity, and I hope you guys have learned something tonight. I think for me, just to say, let's make impact, let's make a difference. That for me is what this organization is about in your lives as real estate investors, to grow your wealth, at the same time sleeping well while you're assisting somebody else, and use the opportunity within the lifetime of the opportunity. That's what I would say.
Great. Our virtual audience and also our local, I think you put your hands together for Daniel and for Gerard, and of course also for James, who's online. And so, ladies and gents, here's a free event that you can go to next week. It's at the Money Summit, and it's the next Thursday, which is the 14th of September. The Money Summit actually is a full day event. And in fact, Daniel and his team, I think Gerard might be there. I'm not quite sure who's all going to be there. I know James will also be there. So certainly, this is an opportunity to engage Now, the Money Summit has, there's a free entry opportunity for everybody that's on this show here. It's at the Sandton Convention Center. So obviously it's for people that are based in Johannesburg first. For those in Cape Town, you're welcome to fly over. You can book now. There is a link. Okay, and it's a property investing forum, and that starts at 5 o'clock registration. You can see our speakers there, and Daniel is one of our speakers, along with Estiani Marks. She's going to be talking about immigration, and she's from Lightstone Properties, valuation. We've got Bonga Zulu. Bonga is from Tough. They do property finance. You know, if you're looking at a building like for student accommodation, any resi building that you got multiple residential, they finance that. And they focus on inner city, but inner city could be inner city of Belleville, it could be anywhere. So it's not just the inner city of the city. They do a lot of the outskirts now of cities. And they're specialist financiers for investors. Jaco Grobler, he's a buy-to-let expert, and Rita van Rooyen is a student accommodation. In fact, she's also from Belleville. She's based in Belleville, but she has a national portfolio. She has portfolio in Potchefstroom, she has a portfolio in Port Elizabeth, in Bloem, Pretoria, and she's built an immaculate, incredible portfolio. Very dynamic lady, somebody that you really want to listen to. In fact, she's even, we had a training session on student accommodation in Cape Town recently. She's doing it again on Saturday the 16th. So if you're interested, we'll come along. You can go online and see it on the REI website. So it's for free, ladies and gents. All you do is you click on the link. There's a code. It says REI guest, real estate investor guest, to gain free entry. It's free, everybody. It's free. So please join us. It really is going to be a fun evening. So, and then I think that's the most important thing in terms of, there's also, for those of you who want to join our webinars, it's going to be on Thursday. I think there is a link over there. Okay, you said you can just, if you go onto our website, rei.ca, you just go into upcoming events. There is a QR code. You can maybe just click on the next one if you don't mind. And then we do our live events, which is in fact next Thursday. And I'll mention our next one also, which I'm going to invite you, Daniel, and also is to the Solga event. And that's when the developers and financiers and everybody are coming for a solution. I'm going to make sure that you're on that agenda. I think you can add massive value. We have a number of other events that's also in Cape Town. The Rhoda conference will be next year. We've got a number of other conferences. And then the next one, we got a newsletter which goes out 3 times a week, different, whether it's events, whether it's a magazine, or whether it's just latest news in the property, so which you can sign up for. And I think there's one more after that. We've got a metaverse. And yeah, that's me with one of the glasses. I'm the young one. That's my avatar. So you can design your avatar and you can go onto our space and you can actually engage and actually read our magazines and interact in the metaverse, which is quite cool. So that's our media room and where people can engage. For you, the audience, you've been fantastic. That's also, yes, Real Estate Investor Magazine. And that's Ralph Levitt. And I know Daniel knows him very well. He used to counter bid against him in the early days for the distressed properties when he used to hunt those ones. And Ralph ended up selling a lot for the banks at the time. And that's also when they moved their model because, you know, at that stage, the banks moved away from the auction model to the estate agent model. Not to say which one is right or wrong, but that was just, you know, of the time when we saw the auctioneer. So that's the story tonight. I want to thank you, the audience, for being here today, for your interaction. I think you've been fantastic. For you, the online audience, you've been wonderful. We'd love to see you. Those in Johannesburg, as I say, on next Thursday, we'd love to see you there. And I think in closing, thank you very much. Flight, my story is 8. But I think, ladies and gents, I think once again, put your hands together for our great panel and for you. I understand, hang around over here. We do have some snacks. Unfortunately for our virtual audience, we only have virtual snacks for you. So if you're in Cape Town next time, please come along. And I'm sure we're going to do a follow-up event. It's been very successful. We've had a great series so far, and I'm sure we could probably snuck one in just before the end of the year, Daniel, before the year's out. I think we've got to do another one of these events. It's been fantastic. Thank you for the audience for coming. with the bank. So that's who we want to get the banker here. And we don't want to go bank bashing. We want to, they are partners. Remember, we've got to work with them. They also provide the finance. We want them on our side. We want them to help us all along the way. So thank you very much. This is Neil Peterson of Real Estate Investors signing out. Stay safe and successful investing. Thank you.